If not, these are great questions to go and ask the person you work with and maybe trust already.
I
Absolutely.
see. So, okay, gotcha. I see what you said. Thank you.
Yeah, Shan, it wouldn't hurt with the investing you're doing to reach out to CJ maybe or your tax professional and ask the deeper questions. You know, again, it's what you don't know that costs you the most. And sometimes you're limited to the education that your CPA has. You know, that's one of the reasons that I go out and I usually get 3 referrals, or I have a great relationship that manages big clients that they do multiple types of investing. So I know for a fact that I'm getting the best information out there.
Yeah, and then just make sure that they make sure you just get an explanation that a clarification that makes sense, right? If someone looks at your situation and they can tell you like, hey, here's why you don't get it's not treated for you this way. Versus, oh, okay, there's an opportunity to do this, or even ask like, what would need to be true for me to get these benefits? Is a good way to ask too. Instead of like, no, it's like, what would need to happen for me to have the benefits?
Right.
Absolutely.
I gotcha. Because truly on this one, we're passive. I understand, but I'm just thinking, just like you said, because I'm real estate professional, try to get the benefits. So yeah, I gotcha. Thank you. Appreciate it.
Any other questions?
Is there something that you guys find the most confusing around taxes and tax planning?
Definitely, because I mean, I'm speaking for myself. You don't know what you don't know. My question to you, CJ, is you're doing tax planning. Do you do step planning as well? Like, set up trust, all the whole nine yards too.
Yeah, so for that, we usually are one professional involved, and then we generally have either you as a client, you'll have an estate planning attorney that you already trust, or we have a couple of relationships as well that we make happy to make introductions to, and then it's just kind of a team approach of from the estate planning side, we don't set up like trusts or LLCs. We more so advise on the tax implications, but we'll work with other professionals on your team to one make sure that you are that you have the best plan in place.
What state are you in? Florida, did you say?
I'm in Florida, yeah, but we work with investors nationwide.
Okay, thank you.
Where are you located?
Dallas.
Dallas?
Yeah. Thank you.
So one question I have a lot, because people invest with us through SDRA, so self-directed IRA, and we always feel that we can grow their wealth tax free, because some investors choose to like personally just take that investment out of their savings account and invest it, and then we're forced to send them the distributions back. So they're having to take that as earned income. And with a IRA investment, we're just paying their investment company back, the trust back. So therefore, essentially, that's not taxable income, correct?
Yeah, so it is a nice it's a nice approach to if you have money in an IRA and you say, hey, I kind of want to use this to grow my wealth through real estate and kind of taking that into put it in a self-directed and investing there. So it would be restricted. Any money that comes in needs to stay in an IRA just like it would in a traditional approach. And just like with anything, there are nuances to self-directed IRAs as well, particularly with like how much debt is involved and some calculations there. But generally, it's a good approach if you have funds there that you want to also use towards real estate and invest that way. And a lot of our clients do that as well.
Yeah, because we always tell them, if you have the possibility, get set up with a self-directed IRA company, allocate those funds into one vehicle, and then invest with that vehicle, because as we mature the asset that we're invested in, we're going to send you those quarterly distributions. So you're not being taxed on those yearly distributions throughout the year. And then when we exit, when we have that large lump sum of money that comes back, which is your principal that you invested plus your returns, any overages, that whole lump sum of money is not considered taxed because we're paying it back to your IRA account. And then at that point, if you choose to reinvest with us, all those profits was not taxed, and you're able to reinvest that again and take it another turn. So, like for instance, a lot of our investments are 2x multiples. So if somebody invests 100 grand and they got 200 back, that's essentially tax free at that point, and they reinvest at $200,000.
And yeah, just accelerating the growth of your investment and your wealth, right? And yeah, is that one approach. And just with real estate in general, there's a lot of ways to just accelerate this wealth building process through real estate. So um brings me to like thinking like 1031 exchanges and just the tax efficiency there, right? So selling properties and at a gain, and instead of paying taxes, roll that into another investment.
Mm-hmm.
So lot of great strategies and ways to accelerate things.
Absolutely. But, I think you have to explore getting around the right circles, the right people to be able to ask the right questions. I think that's the biggest thing. A lot of people ask me a lot of questions, and I'm like, come and ask these questions on this platform or other platforms, because I'm telling you, you can spend a lot of time paying a lot of taxes if you don't ask the right questions and don't get around the right professionals, of course.
100%. Yeah, for me personally, I'm always looking at what rooms I can get in and just get around other people, and what ideas haven't I thought of, or just trying to borrow from people's learning, right? And yeah, I think that's great.
What would be a book you would suggest any real estate investor read?
A book any real estate investor read. Uh, Really good question. Let me think. To be honest, I haven't read like I early on I read so many real estate specific books. Now it's more general business.
Yep.
I will give you one there. The Road Less Stupid. I don't know if anyone's
Oh,
read that one. Uh, Excellent book. Um, just on like business strategy, which I mean, real estate investing is a business, right? So
yes.
just how to eliminate, how to reduce the risk of making bad decisions, how you should approach things strategically. Really great book that I just got finished reading.
I like that.
Yeah.
So, of course, Rich Dad, Poor Dad, but Rich Dad, Poor Dad's advisor. So, Tom Wheelwright, super smart guy. I think he has a book out called Tax Free Wealth, and a
Yes.
couple others. But think about those. Again, if you can't afford professional consulting, then think about all the different ways that you can get education, and YouTube, podcast, anything you can figure out. Get in these inner circles to where you can either buy the book and get on Amazon, because I've learned a ton from reading books and going to Zooms and going to conferences. Find these things, seek them out, and then so you can ask better questions. So sometimes when I started, I didn't even know to ask the right question because I didn't quite have the level of education I have now to be able to even say, hey, what is depreciation? And what's bonus depreciation? And then, sometimes when I was getting started, I didn't know that there was a difference, or there is no difference between a cost seg and bonus depreciation. So, CJ, if you don't mind, can you go into that real quick? So, a lot of people say, oh, we did a cost seg. Well, what does that really mean?
Yeah, I can definitely touch on that. And yeah, just of course, Rich Dad Poor Dad, and then yeah, Tax Free Wealth is a good, just if you're trying to get some general tax insight, right? Tom Wheelwright, written by him. So Those are definitely good ones. But and then a lot of people have like a lot of people will put content out consistently, and people have like communities and things to join to get some of these ideas. But yeah, so on cost segregation, right? It's kind of a hot word within real estate, and what that does is it's basically the way to accelerate depreciation. And when I mean accelerate, I mean instead of the traditional way of taking depreciation expense, you're pushing it forward into the year in which you do a cost segregation study. So depreciation is a tax concept, right? It's a tax item. It's a non-cash expense. It's just after income, actual expenses. Then for tax purposes, we factor in depreciation to help shelter some of that rental income. And depreciation expense is calculated depending on what type of property: residential, 27 and a half, commercial, 39 years. So to use some examples, right? So say it's $1 million property. Say on average 20% is allocated to land, so 200,000. 800,000 would be allocated to the structure, the building, so depreciable, right? So 800,000 in that example. If you didn't do a cost segregation study, say it's residential, say it's multifamily, it's going to be 27 and a half years in which you'd recover that 800,000 expense. So every year you're going to get a little slice of it. Cost segregation is when an engineering firm will go and evaluate the property and break that property into different buckets. And why that is important is some of those buckets are eligible for bonus depreciation, which means they can be written off immediately as opposed to the 27 and a half years. So cost segregation is the study that enables bonus depreciation. Bonus depreciation is the actual provision that allows you to take the upfront deduction. Does that help break it down?
Absolutely, man. Thank you. Great job on that. Another thing, so you said there's a difference between commercial and residential, like 27 and a half years to 39 years. So is multifamily considered commercial or residential?
So generally, it's going to be under 27 and a half residential
Yep.
real estate for tax purposes, and fall under that 27 and a half bucket.
Yep, absolutely. So
Yeah.
thanks for clarifying that. A lot of people think that, because it's a business and it's using a commercial loan to close it, anything over 5 units, that it's considered commercial. And a lot of the times, no, it's actually residential real estate. It's housing. And it's not, it's used in a commercial loan, anything 5 units, it's what it's calculated at, meaning also the big benefit is that's calculated net operating income to get your value of the property is another big factor. But you use a commercial loan, but it's actually a residential property.
Which
Cool.
makes a difference for depreciation. And then, cost segregation just kind of fuels that. It puts fuel on the fire. So
Yep.
definitely a hot item within real estate. Just like with anything, I'll caveat, there's always considerations, right? So generally really great if it's a bit of a hold period. If it's something an asset that you intend to turn around and sell in the short term, then you might want to think twice about doing a cost segregation study. There's this concept of depreciation recapture that can be unfavorable. So just I always go back to just make sure you work with someone that understands all of everything that's on the table, because you can just run out and do something because you heard it was a good idea, but that the good idea, the clip on social media didn't know all of your goals in fact pattern. So
Yeah.
just make sure
Yeah.
you have someone that can give you all the details.
So I know it's a deep subject, but let's talk about recapture for a minute. So I was helping a investor that has bought a property. It was owner financed, and he was wanting to pay the property off, but essentially the person that owns the property, he did not want that property paid off. And, he wanted to know what his tax liability was. So we connected him with a local CPA that's done real estate. And immediately the question come up, and I had forgot about it, was recapture. And he said, well, honestly, he could face a lot of recapture taxes because of that state does evaluate that. Whatever he's wrote off, it was supposed to go for so many years. Well, now he's selling it early. He might have some exposure because of recapture.
Yep. It's definitely something you need to be aware of and can create a surprise result, right? If you're not understanding and planning around that. So a lot of like what we'll do is kind of model out if you sell this asset, what are the tax implications, and kind of spell that out. Yeah, so what happens is if you've taken accelerated depreciation and then you turn around and sell that asset, you're generally going to have to recapture that depreciation in terms of increasing your gain, and it's going to create where it's going to be taxed at an unfavorable tax rate. So definitely something you want to be aware of and plan around. And if you're going into a deal or acquisition with the intention of it being a short time horizon, then I want to consider whether if cost segregation is the right approach for that deal specifically. So you could work for another one, but maybe not for that one.
Sure, because your two different things you're measuring is a long-term capital gain and a short-term capital gain, and there's actually that's split in the two. Is that correct?
That's split into to two, so long term and short term, and then you would basically the calculation would be okay. What was your overall holding? So if it's over a year, long term capital gain, and then it's what portion is depreciation recapture, right? So that could be taxed at 25% as opposed to the lower favorable rates. So it can definitely create an adverse tax result, and then also it lowers your basis, right, and increases the overall gain. So a lot of people are confused by this because it kind of gets in the weeds, right? But I have $1 million property. I took 500,000 of depreciation. I then sell it for $1.5 million. My gain is not $500,000, the 1.5 less the million I paid for it. It's you have to factor in that depreciation, right? So it's the $1.5 million you sold, the $1 million you paid less my depreciation expense of 500,000. So my overall gain is actually $1 million.
Very smart. Thank you.
Yeah.
So we got about 8 minutes left here. I want to definitely get in questions that you guys have had throughout listening to this. Definitely, if you can, put in your contact information if you're willing. And man, this has been a good meeting. It really has. And we have this recorded. Anybody that wants it, they can get it on our community. But any questions that you guys had so far that you didn't know about? What's your biggest takeaway from this meeting so far? Contact information's in the chat.
Mine would be oh, go ahead.
Sorry, sir, go ahead.
Oh, well, mine was just the depreciation. I thought because since it is commercial, taking out a commercial loan, it's more than 5 units, etc., that the depreciation would actually fall to that 30 plus years. But it's interesting because it is residential. So yeah, that's a huge takeaway for me. For sure.
Awesome. Thank you. Yeah, because a lot of the times, 39 years would actually be a little bit worse for us as a long-term hold real estate investor. We'd rather be shorter. Like I wish they'd change it to 10 or 5. That way I could depreciate all of it before we exit.
Well, that's what at least the cost segregation study helps you achieve some of that result, right?
Yes. Yeah, because essentially, you're depreciating, maybe the roof is 10 years, 15 years, the carpet is X, the doors are X, the concrete, so you're depreciating all these different things. And that's what they're doing during a cost segregation is they're really engineering and like CJ said, is bucketizing every single one of these and then giving you an overall study. This is what you can do year one, and how you can accelerate this.
And I'll give you one added benefit that not a lot of people talk about when it comes to cost segregation. A lot of what's talked about is just the accelerated depreciation you're going to get. But another added benefit, and you have to work with the right company that will do this level of detail. Not all of them will. We have someone in our network that do these kinds of studies, but it's a more detailed study that really breaks out the property and why that's helpful. Like you mentioned, the roof, right? It will associate a value to the roof, right? So what happens when you need to replace that roof? We know what the original value was specifically for the roof. We can go and then write that cost off and then place the new roof in service and add that to the depreciation schedule. It's called a partial asset disposition. So we're able to see what was the value of what needed to be replaced and go and write that original cost off. Now, again, a lot of people, not every cost segregation company is going to give you that report, but there are ones that will, and those are really valuable in that case.
So anytime we've done one, we've been very in tune to the numbers because essentially we're raising capital, right? So we have a loan on a part of that property, but we also have liquidity. So how much can we physically write off? What's the dollar amount of which we can write off? So that's extremely important for us to actually have a detailed report so we know number wise what we can actually pass through to our investors. Any other questions? Man, this has been really good. I know it's really close to Family Day, hanging out with the holidays and everything. So we had a low attendance tonight. But as I said, this is recorded. Anybody that wants it, they can get it. It's a part of our community. And what we really want to do here is make sure that we get this information out. Because for us to be successful real estate investors, these are the skills, the knowledge, the education that we need to be able to be educated out here when we're raising capital, buying properties. Because here's the thing that I've seen a lot is a lot of people come at this with a little bit of education and they make more experienced operators look bad because they're selling stuff with half the education. And they're buying stuff with half the education. They're investing with half the education. And they don't get the full benefit. And that full benefit is really terrible because the full power of real estate investing, it's the greatest way to grow and protect your wealth that I'm aware of, truly. So why would we not want to have full education to give our investors and us full advantage of what we can get here? Well, cool. We're going to bring this thing to a close. Everybody got the chat saved so you can refer back to it. So everybody got Thanksgiving tomorrow. So I know we got one tomorrow. So everybody's doing Thanksgiving tomorrow. Yeah, cool. Well, I wish you all very, very well. And I wish you have a happy holiday. And I would leave you with this. One of the things that I do during this time is reflect on my why. And when I have at least 20 people in my inner circle of things going on, I can see real quickly that these are my family members, and why I'm doing the things I'm doing is those family members, to spend more time with them. I feel your greatest ability is your availability to your family. So the quicker you can create that availability, working less and having more on time with your family, that's what's most important. So remember that when you're sitting with your family, if you're a little bit confused on your direction, if you're a little bit confused on why you're doing these certain things, we all face depression, get stressed out. We get faced with anxiety. We're doing something new or we're stretching ourselves. And it's very important to me to really know why I'm doing something, why I'm passionate about this. So think about that as you're turning off from the corporate world and you're sitting there with your family. Think back and sit and think about, this is the reason I'm doing this, is my family. to have more availability. So we hope that each and every one of you enjoyed this. We'll see you on the next one. Thank you all so much.
Thanks,
Enjoy.
guys. Thanks, Eddie.
You're welcome.
Thanks, Eddie. Thanks, Eddie.
Happy
Thank you, Eddie and
Thanksgiving.
CJ.
Thank
You too.
Happy Thanksgiving, guys.